On Wall Street, the dance of sectors begins. Since the end of October, the Russell 2000 index, small caps, has done better than the S&P 500 and the Magnificent Seven. And there are those who wonder if the correction of the aim of those who fear excessive tech exposure is not in the making. But where did the long-awaited Christmas rally go, i.e. the traditional Wall Street run in December? Many wondered this question last week, yet the ingredients for a rise were all there. Among small investors, optimism measured by AAII was skyrocketing at a 12-month high. The appetite for risk, calculated by Goldman Sachs, was at its highest level since January, and the sentiment of large investors was close to the highs of July 2021. In fact, something unusual can be seen in Wall Street's behavior over the past 2 months. The new record set by Wall Street on December 11th seems rather like one of those buy-the-dip rebounds. But the strange thing is that the index took more than 6 weeks to recover the previous level. And moreover, the new record, instead of foreshadowing the continuation of a bull market, has the appearance of a double top. And then who said that the stock market must necessarily fly in December? Mostly it was like this. But since 2020, we have seen it go up 3 times, and spectacularly, and twice down. Last year, the S&P, perhaps a little fatigued by a 28% run since the beginning of the year, lost 3.4% between December 6 and 30. This year, it could also feel satisfied with a not inconsiderable rise. More than in numbers, it is likely that this slight malaise on Wall Street has to do with something more serious, a reflection on the developments of artificial intelligence, or on the sustainability of the huge investments of hyperscalers. The news that some of OpenAI's data centers will be completed in 2028 instead of 2027 was enough to trigger a series of sales on stocks in the sector, such as CoreWeave and especially Oracle and Broadcom. NVIDIA itself, by far the most profitable company in the sector, but with a forecast of investment spending of $4 trillion over the next 5 years, has seen the stock lose 17% in just over a month. It can be seen how the debate on the alleged speculative bubble in the AI sector is shifting from stocks to bonds, those already issued during 2025 and above all on those expected in the next 5 years. It is no coincidence that, in the December BofA survey, 38% of large managers still reported the stock bubble, down sharply from 45% in November, while the percentage of those who fear a credit bubble has grown. These incipient fears have been transferred into practice, as evidenced by the rise in yields between bonds issued by AI companies compared to treasuries. The spread of the Oracle bond has risen to 201 points. It is true that large hyperscalers can finance themselves largely with robust cash flows, but the circularity of their investments would still make them exposed to market risks. The giants enjoy good ratings, but things could change. It is likely that the slight malaise on Wall Street is only the result of what operators have emphatically called sector rotation, out of big tech stocks and rediscovery of traditional ones. Keeping investors' mood high is now the prospect of a truly market-friendly Fed. And if Jerome Powell has envisaged only one rate cut in 2026, the new Fed modeled by Donald Trump promises miracles next year. According to Citi analysts, we will see rates fall by another 75 points, which, combined with the fiscal stimulus promised by the White House, would make Wall Street a real Bengodi.